Hello, I'm Mark Patton. Thanks a lot for taking the time to participate in our investor workshop. This is our workshop that's going to be discussing the performance of super diversification during the fourth quarter of 2018 as well as the full year of 2018. So with that, let's get started. Um, the length of this workshop is expected to be between 20 and 30 minutes. If you're participating live, just a reminder that all participants are muted, so there'll be no background noise. If you do have questions and you're participating live, there's a chat window. You can chat those questions to me. I won't promise that I'll see them during the presentation, and if I happen to miss your question, I'll certainly make sure that I follow up and get an answer to you regarding whatever it is you might ask. If you're watching this via the replay, which it will be available on our website, if you're watching this via the replay and you have questions, you can always go to our website. My email address is up in the top left-hand corner. Our phone number is up here, and you can also go to the Ask Mark button here in the top right-hand side. It'll bring up a form, and you can type in any question that you've got. Of course, when you do send this form, just so you know, it goes to both me and our entire customer service team. So just a heads up that that will go to our customer service team as well as me. Let's get started with some discussion about super diversification and performance. So I'm going to go out to our website, and I want to start by providing a little overview of super diversification and some of the features of super diversification. Number one, we believe that super diversified portfolios are simply better than other portfolios because they're more diversified. Most portfolios are diversified in stocks, bonds, and cash. All of our super diversified portfolios include additional asset classes beyond just stocks, bonds, and cash. Historically, research demonstrates and our performance has demonstrated that that's produced better long-term returns. Another point is that super diversification is built around what we call math that works. There's a tremendous amount of research that has gone into super diversification, and it's really all built around math and mathematical principles that have proven to produce great long-term success. With that being said, I want to remind everybody that math doesn't always work during shorter windows of time. There are no guarantees. And a good example of that is the flip of a coin. When you flip a coin, you know that the probability is 50% heads or 50% tails. We know that to be true. You also know that if you flip that coin 10 times, sometimes it comes up 7 or 8 times heads and only 2 or 3 times tails. The math didn't work exactly right during those 10 flips of the coin. Now, if you flip that 100 times, it's far more likely that you're closer to 50 times heads and 50 times tails, because given more time and given more examples, if you want to call it that, or samples, the math is more likely to work. The same is true with investing. When you give it more time, that math is more likely to work. There certainly are going to be shorter windows of times, like days, weeks, months, and even years, where the math doesn't work exactly the way that we want it to. That's just the way that math works. When it's not working, it doesn't mean that the math has stopped working. It just means that it's not working during that window of time. There are two other things that I want to remind you about super diversification. One is that it's built on the success of others. I did not come up with all the ideas and concepts of super diversification. I did research on others out there that have produced great success. The Yale University Endowment is really the one that I focused on because they've had tremendous long-term success. And a lot of what we do in super diversification, it is modeled after the Yale Endowment. It's not trying to replicate, but it is modeled after the Yale University Endowment. We're going to talk a little bit more about that today. And the last point about super diversification is that every one of our clients' portfolios is customized or tailored for each individual client. So we're going to look and consider a lot of different things. The risk profile, the amount of money being invested, the type of money being invested, different things will impact how we can invest a client's portfolio for them. So that leads to a question. Today, I'm going to be showing you performance on super diversification. I'm going to show you the investment strategy that is the most common for our clients, but it doesn't represent all of our clients. So I want to talk a little bit about that because I've had questions before about what is that performance information that you're showing. So under About Patton and Disclosure, we can go to our disclosure page. This is the same disclosure that when you log into our website that you click the I agree to. So there's a lot of information here. Actually, some of it's pretty useful information, but we'll scroll down here to the information about what we call our performance composites. It starts right here. So what we talk about here, so it starts with this sentence here. So what we talk about here are the different investment strategies that we utilize for our clients, and we've got them divided up into 7 different categories or strategies here. The top one would be our super diversified portfolios that include our flex strategy. That is the majority of our clients. So our flex strategy is our proprietary hedging strategy. We have another proprietary hedging strategy we call our edge strategy. It's simply a less aggressive version of the flex. So we have some super diversified portfolios with our edge strategy. We have other clients who have neither the flex or the edge. We simply call those better diversified portfolios, and they are without an allocation to either the flex or the edge strategy. So most everybody is going to fall into one of those 3 different buckets. Then in addition to that, we've taken each bucket. So let's take this strategy here, super diversified with flex. We've got 3 different risk profiles: conservative, moderate, and growth oriented. So we've got all these different categories for our client portfolios, and now all that information for every one of our clients is presented here in this table. So this table defaults to our most common strategy, which is, again, is our super diversified portfolio with the flex strategy with a growth orientation. You can change that to the conservative or the moderate here. Here's the better diversified up here and so forth. But what this will show you is the performance going all the way back to the month ending February of 2010, because we started at the end of January of 2010. So the first full month was February. You can see all the way back in 2010, we only had 2 clients in our super diversified flex growth strategy. And you can see this composite number is the average of that client's performance. Whoops, that just resorted there. That's the average client performance for that given month. So we can scroll down here and we can see that today we've got 67 clients in this particular strategy, and you can see the average performance month by month. So when you go to our website, in particular, go under Why Patton and Performance, it is that information, that strategy that is being represented in this particular graph under Why Patton and Performance. So this is real client money with all similar strategies. The client's portfolios are not exactly the same, but they're very similar in strategy, similar in risk profile. So as you can see, just as a backdrop for our conversation today, super diversification has produced great long-term returns. Of course, 2018 has not been great. We can see that on the right-hand side of this graph, but this blue line represents the performance of our super diversified growth strategy for our clients. You can see over the course of the time, going back to January of 2010 through the end of the year, super diversification is up 133%. And this green line represents what's called the average private client index. It is the most utilized index representing the average performance of people in my business in their clients' portfolios. So this is the most widely used index representing my competition. You can see over the and by the way, they have 4 different indexes, and we've used the most aggressive index because that would be most representative of our super diversified strategy as well that we're comparing it to. And you can see over that time, that index is up 78% since January of 2010, again versus 133. So we're very happy with the way super diversification has performed over the course of since its inception back in 2010. In spite of what's happened in 2018, which we're going to talk at length about. So that's kind of a backdrop for us. And by the way, we've done a tremendous amount of research trying to find other investment strategies that have performed as well as super diversification. And quite honestly, we can't find any that are out there. So we really do believe super diversification stands head and shoulders above the majority of the market that we can certainly find out there. Let's talk about 2018. 2018 line graph here. So this represents the performance of major equity indexes. The blue line on this graph, going all the way back to January 1 of 2018, the blue line on this graph represents the S&P 500, what we would call large U.S. stocks. You can see that there was a very strong run in January, as we all might recall at this point in time. It seems like a distant past, of course. We had a fairly quick and serious correction that followed that. And then the market rallied again, and the S&P, the blue line, peaked in late September of 2018, and then has come off of that. It bottomed on Christmas Eve and rallied a little bit through the end of the year. We'll talk about the closing performance numbers here in just a second. The orange line represents U.S. small stocks. You can see that they actually did better through mid-year, but then have fallen harder during the bear market or correction here. And then the other 2 lines represent international stocks. The green line being international international developed markets. That would be European markets, Australia, and Japan. Those are the three major developed regions. That's represented in the green line. You can see that the international stocks have underperformed U.S. stocks, as have international emerging markets, which would be the purple line, have underperformed as well. Emerging markets are like China, Brazil, and India, and so forth. This next slide will show us the performance numbers. So for 2018, the S&P 500 large U.S. stocks lost about 4.5%. Small stocks were off 11.1%, so significantly more. International stocks even more, almost 14% for developed markets and over 15% for international emerging markets. During the fourth quarter, you can see that U.S. stocks, large U.S. stocks, were off 13.5. Small were off almost 20, a little more than 20%. International stocks surprisingly actually held up a little better during the decline in the fourth quarter. In particular, emerging markets were only down 7.5%. So that's an interesting data point to see how that was during the fourth quarter. And peak to trough, so this would be the high point to the low point, and this is what people would use to gauge whether or not we've technically fallen into a bear market. A bear market is defined as being down 20% or more. You can see that the S&P 500 using closing day prices was down 19.3% at its worst point from high point to low point. If you look at some of the intraday prices during the day trading, and it actually fell more than 20%. So some people are going to argue that we haven't entered a bear market yet. It's really neither here nor there. The S&P was down 19.3% nonetheless. Small stocks from peak to trough lost almost 27% in international stocks. Developed markets 22, and internationally emerging about 26.5. So that gives you a snapshot of 2018. It was tough sledding for equity markets around the entire world, with U.S. large stocks actually holding up the best, which we're going to talk about what that's looked like during the most recent bull market as compared to another bull market in a few minutes. So with that, that's kind of our backdrop for 2018 and what performances looked like both for the full year and for the quarter. Let's take a look now at super diversification. So I'm going to go to our super diversified portfolio statements section. So this is where our clients go to see the performance of their portfolio. I'm going to drop down. Let's see. I would like to go first to take a look at the holdings in a super diversified portfolio, just as a reminder of what this looks like. So you can see that a super diversified portfolio is different than most portfolios because of two things. Number one is that the alternative asset classes. Again, we've diversified beyond just stocks, bonds, and cash into these other things. The alternative assets, those are the other things. You've got commodities, gold, real estate, Berkshire Hathaway, and our hedging strategy, making up a 51% allocation. Alternatives, a little bit more than half the entire super diversified portfolio. That makes it distinctly different than a traditional portfolio. The other thing that will make it different is our allocation to international stocks. You'll see up here at the top, U.S. stocks between large, mid, and small, total 18%, and international stocks are at 16%. That's split evenly between developed and emerging markets. So you'll see we have almost an equal allocation to both U.S. and international stocks. That is very different than a traditional portfolio. In a traditional portfolio, we would define, and we'll call this our benchmark portfolio as well, it's typically something that's going to be more heavily weighted toward U.S. stocks and less toward international stocks. This is a very common portfolio allocation. We see this a lot from industry numbers that we look at. So you'll see that the U.S. stocks represent 60% of a traditional portfolio and only 10% in international stocks. And then the other 30% is between bonds or fixed income and some cash. So this is a very typical 70% stocks, 30% bond portfolio. On our website, we call that the benchmark portfolio. It's what we're benchmarking or comparing super diversification to. And it's also what I'll call a traditional portfolio. Some people would say, so why is it that we've allocated super diversification the way that we have? And as I said, we've really modeled after the Yale University endowment. And on our website, we actually have some information about the Yale Endowment portfolio. So here's the page that shows that, and we can see the portfolio allocation of the Yale Endowment, how have they allocated their money. One thing of note, they've allocated 75% of their portfolio to alternative assets. We've not done that. Again, we're not trying to replicate the Yale Endowment, but we are certainly trying to model ourselves after that. So they're at 75% and we are not. We just simply don't think that's right for individual investors. That's another conversation. Another point, though, that I want to make here is about their allocation between U.S. stocks and international stocks. Up here at the top, you'll see that U.S. stocks only represent a little less than 4% of the Yale Endowment portfolio, a pretty small allocation, of course, and that compares to international or foreign stocks at 15%. So you'll see they have a much larger allocation to international or foreign stocks. Again, we haven't done that, but we've modeled ourselves after that to have a larger allocation to international stocks than most other investors do because long term it's proven to work. That's what they've been doing. We're doing the same thing. Our research supports all of this. So that is one of the reasons why we've maintained a larger allocation to international stocks because long term it has worked. That being said, it hasn't worked so great in 2018. So let's take a look at the performance of super diversification as we came to do here during 2018 and for the fourth quarter. So I'm going to go down to what we call the comparable trends report. We're going to take a look at, we've already looked at kind of the full picture on our website. So let's take a look at just 2018. I'm going to turn off the stocks and bonds line. So the blue line on this graph, it's called the family line. This is the super diversified portfolio. So you can see over the course of 2018, the super diversified portfolio was down 9.25%, and that traditional benchmark portfolio was down 8.9%. So we underperformed by about 1/3%. Disappointing, yes. Significant, no. And we'll talk about what drove that slight underperformance. What some people have been really disappointed by is that when you compare that to the S&P 500, the S&P 500 is only down about 4.5%, as we pointed out earlier. The bottom line, though, is that the S&P 500 simply isn't a good benchmark to measure against. It is just one asset class in nearly anybody's portfolio, and I'm going to show you some data that would suggest why we don't want to be simply in that one asset class, even though during 2018 it held up better than even a diversified portfolio did. So that's 2018. Again, 9.25% down versus 8.9. We can look at the quarter, but it's really kind of the same story. If we just look at the last 3 months, again, you'll see that if we just turn the bond line off, you'll see that super diversification, the traditional portfolio, and the S&P 500 were all down very similar amounts during the fourth quarter. Again, a little disappointing for diversified portfolios. You'd expect or hope that they didn't go down as much as the S&P 500. Again, they're in shorter windows of time. Sometimes that's just what happens. Another comparison that we can look at is the year-by-year returns. If you want to go back a little further and look at these year-by-year, this table shows us that we've got the super diversified portfolio, the family here on the left column, the benchmark portfolio here. So again, you can see in 2018, you can see the down 9.25% for super diversification and 8.9% for the family or for the traditional portfolio. You can see last year, though, how different and how much better super diversification was. It certainly ebbs and flows, but as we've already demonstrated over the longer period of time, the difference, we can go back to this comparable trends report very quickly, and you can see over this longer period of time, you look at super diversification up 81% during this window of time, and that traditional portfolio only up 38%. So long term, tremendous performance from super diversification. 2018, very similar to that traditional portfolio. So let's talk about what's been driving that. Let's go to the asset classes report. Let's look at this for just the period of 2018. So we'll start on 12/31 of 17. Let's scroll down here. And here you've got a graph that shows the performance of all the different asset classes that make up our super diversified portfolio. Large U.S. stocks is up here at the top, down about 4.5%. Mid-sized stocks were down 9%, and U.S. small stocks down almost 11%, as we've already talked about. International developed countries down 15.5%, and emerging markets down 21%. So equities around the world had a very challenging run in 2018. U.S. large stocks held up better than all others, as you can see here, but that's not always the case. And we certainly don't want to bet on that being the case going forward. So this is 2018. Some people are asking the question, why would we diversify into these other equity markets when U.S. large stocks are the ones that have been carrying the day? And the answer is because they don't always. When you look at this graph, this is pretty neat, I think. This is the performance during the bull market that began in February of 2009 and may have peaked in September of 2018. May have peaked because we're not quite sure where we are exactly right now or where this goes. But nonetheless, from February of 09 to September of 18, U.S. large stocks gained 384% in value, up almost fourfold during the most recent bull market. Small stocks about the same. And you can see international developed and emerging markets only up 122 or 129%, far lower performance. So international stocks have not only been dragging down the portfolio in 2018, but during the entire bull market. Quite honestly, I wish somebody would have told me that was going to be the case back in 2009, but the reality is we don't know when this is going to happen. And it doesn't always perform like this. If you go to look at the bull market that occurred before this, which would be from March of 03 to September of 2007. So this is the bull market that gets wedged between the tech wreck of 2000 to 2002 and the financial crisis of 2008 and 2009. This is the bull market in between there. U.S. large stocks doubled in value, approximately up 98%. Small stocks up 140, and you can see international developed markets twice as good as large stocks, and internationally emerging markets 4 times as good as large stocks. So it just depends on what period of time we look at. The bottom line is we never know when we're going to get performance that looks like this and international stocks do better, or when we're going to get performance like this and U.S. stocks do better. The bottom line is we want to be diversified across all these different asset classes to produce the best long-term return possible, and we believe that's the best way to do that. So again, even though 2018 was a year where international stocks didn't do so well, it doesn't cause us to lose confidence in being diversified into those international markets over the long term, the value that that will bring over time. Another question that gets raised is during 2018, the market was down some and the diversified portfolios didn't hold up so well. So the question becomes, is that what we should expect during bear markets? And the answer is absolutely not. Again, the bear market we're talking about has only been going on for 3 months, if it's a bear market. So, we peaked in late September of 2000 and pardon me there. It peaked in late 2000 and late September of 2018. I apologize for that, and has only been going on for the last 3 months. A longer, and again, during shorter windows of time, anything can happen. During longer periods of time, we certainly expect a diversified portfolio to help mitigate some risk during these bear markets. And we see this on our website under this portfolio profile report. This will show you the performance of super diversification during all the major bear markets that have occurred during the past 5 decades. And each bear market is different, so it's not perfect. But during every single bear market, at least during the past 5 decades, every diversified portfolio has helped mitigate risk relative to the S&P 500. So not only super diversification, but traditional portfolios have helped mitigate risk. So we believe that diversification will continue to help mitigate risk during bear markets, maybe not during 1 or 2 or 3 month windows of time, but over a longer bear market, we certainly expect that to be the case. That expectation clearly has not changed. So we maintain total confidence in super diversification. 2018 was a disappointing year. It slightly underperformed a traditional portfolio. It did underperform the S&P by some margin, but that's just what we have to come to expect sometimes. So the question going forward, I think, for all of us is, what do we do? We're possibly in a bear market, and question is, what's my advice? And my advice is 2 things. Number 1, reevaluate your risk profile. If the ups and downs of your portfolio are more than you can either financially or emotionally tolerate, maybe we've got too much risk in your portfolio. I quite honestly doubt that that's the case for most of our investors, but it's something that certainly needs to be considered, and we can reevaluate as needed. Number 2 is if you've got the right risk profile, you want to stay the course. We believe that staying diversified, staying invested long-term is the way to produce the best long-term rates of returns. The only other alternatives that I'm aware of would be, number 1 is to go to cash, pull out of the market. I think that is a foolish long-term investment decision. If you're a long-term investor, being in cash is not the right thing to do. It might make you feel better short-term getting out of the market and avoiding some of the ups and downs, but the problem is you'll never know when to get back in. If you were a good market timer, you wouldn't be in the market now. You'd have gotten out at the end of September before stocks went down. The problem is we don't know when that's going to happen, and we don't know when stocks are going to go back up. So the bottom line is going to cash is a miserable long-term investment decision. The other alternative is to say, I don't believe in the principles of super diversification any longer. That we don't think this math is going to continue to work. It's worked for the last 8 years for us and worked extremely well. It's worked for the Yale Endowment for multiple decades, but maybe now you believe it's not going to work, so you need to go to another investment strategy. I highly discourage that. Of course, I'm biased, but I do believe the math will continue to work. I believe that we've demonstrated over the long period of time since inception back 8 years ago, super diversification has delivered returns head and shoulders above other investment strategies out there. So it's my opinion that you want to make sure you've got your risk profile right and stay the course, and that's how you reap the greatest long-term returns. So I'll wrap up on that. I want to say thanks to all of you for taking the time to participate in this workshop. Thank you very, very much for the business and for the trust and confidence you've placed in me. If you ever have any questions about anything, you certainly know how to find me either via email or give me a phone call, and I'd be happy to address any questions that you've got. So thanks so much, and I wish all of us a wonderful 2019. Thanks a lot.